Okay, let's unpack this.
Ready to dive deep into the fine print.
For this deep dive, you wanted to move beyond just, the simple idea of taking out a loan.
Exactly.
We really want to understand the structural DNA of modern debt. So we're not talking about just borrowing money. We're talking about the frameworks.
The frameworks themselves, the rules that govern everything.
Everything from a 30-year mortgage all the way down to a 2-week cash advance. So our mission is to analyze these 3 fundamental structures.
That's right. The core split between secured and unsecured debt first.
Then the mechanics of the standard installment loan.
And finally, the structural extremes we see in things like high-interest payday loans. We've got a great stack of sources here to guide us.
We do.
And, when you strip away all the marketing, all the complexity, our mission today is really to define the boundaries of debt itself. At its absolute core, a loan is just. It's the tender of money.
One party to another.
With a legal agreement to pay it back. The borrower gets a debt. And the interest, well, that's the incentive. It's the compensation the lender gets for being deprived of using that money for a while.
It's the cost of time, basically. You're renting cash.
You are renting cash, precisely. And that whole relationship is documented. The contract, the thing you sign, it'll normally specify 3 things. The principal amount, so how much you borrowed,
Yep.
the specific interest rate they're charging, and the date or the schedule of repayment. Fundamentally, a loan just reallocates assets. It moves purchasing power from the lender to you, the borrower, for a set period.
And understanding the rules baked into that reallocation is everything.
It is everything.
So if we accept that basic definition, then the single most important structural division in the whole world of debt, the fundamental marker, has to be the difference between secured and unsecured debt.
Absolutely.
This one split dictates everything, right? The interest rate, the risk for the bank, and I think most critically, what happens if you can't pay.
That is the foundational truth. Secured debt is it's debt where you, the borrower, pledge a specific asset. We call it collateral.
So this could be your house, your car.
A car, a house, a boat. It could even be something intangible like stocks or the accounts receivable of a business. The lender then places a legal claim on that property. It's called a lien. And that lien stays there until the loan is paid off, in full.
So the immediate obvious benefit for the lender is just risk mitigation. They're not really sweating the possibility of losing all their money. They have a plan B.
They have a foolproof plan B. The creditor is relieved of almost all the financial risk because the collateral ensures that if you default, they can take ownership of the property.
A process we call repossession or foreclosure.
Right. And then they sell it to get their money back. It just massively reduces the lender's exposure to loss.
So what's in it for the borrower then? Why would you agree to this, to voluntarily put your house on the line?
It's about access and pricing. First, you get much more favorable terms. We're talking lower interest rates, longer repayment periods, are because the risk to the lender is so much lower.
And sometimes it's the only way to get the loan at all.
That's the second and often more important point. You might get credit you just wouldn't have been offered otherwise. For huge loans, like for a house or for major business equipment, the collateral is what makes the deal possible in the first place.
Let's look at the classic examples then, starting with the big one everyone knows.
The mortgage loan. It's the perfect secured loan. The collateral is the property. The lender holds that loan until you make that very last payment, maybe 30 years later.
And car loans are the exact same logic, just securing the financing against the vehicle.
Precisely. The car itself is the security. But, unlike a mortgage, an auto loan is typically shorter, maybe 3 to 7 years. It's supposed to match the car's useful life and how fast it depreciates.
And it's also worth noting there are different ways those are structured.
Oh, yes. You have direct loans, where, say, a bank or a credit union lends you the money straight up. But then you have indirect loans, where the car dealership actually acts as an intermediary. They set up the financing for you through their network of lenders.
We also see secured loans in more specialized areas, right, where people leverage assets they already own.
We do. Our sources point to loans against securities, so shares, bonds, mutual funds. The line of credit is based on the value of the securities you pledge. And similarly, you see gold loans, which are really common in some parts of Asia.
So you just bring in your gold jewelry and they give you a loan based on its weight and quality.
Exactly. The principle is identical. If you don't service the loan, they keep the collateral and they sell it.
Okay, now let's get into the worst case scenario, default. The bank repossesses or forecloses, But what happens if the sale of that asset doesn't cover the full debt?
This is a critical point that a lot of people miss. If the money from the sale, say, from the auction of a repossessed car, doesn't cover the whole debt, the creditor can pursue what's called a deficiency judgment. They can sue you for the remaining balance.
So wait a minute. A deficiency judgment basically turns the leftover debt back into an unsecured debt.
That is a perfect way to put it. That's exactly right.
Right.
The bank has used up its claim on the collateral, but you, the borrower, still owe them money under the original contract. So at that point, they have to chase your other assets, just like an unsecured creditor would have to.
Wow. That dramatically increases the stakes for the borrower. You lose the asset and you still owe money.
And that's often a huge shock for people who thought handing over the keys settled the matter. Just for a moment, on the legal framework for this in the U.S. for personal property, so movable things like cattle or construction equipment, it's all regulated under Article 9 of the Uniform Commercial Code, the UCC,
And why is that UCC detail so important?
because it standardizes the whole process across state lines. Imagine you're a bank lending money to a trucking company that operates in 20 states. You need a uniform system to file a financing statement in each state to legally claim those trucks as collateral.
Without that, it would be chaos.
Total chaos. And it would dry up credit for any large mobile assets. For real estate, it's a bit different. It's governed by specific state laws about liens, whether they're voluntary like a mortgage or involuntary, like a contractor putting a lien on your house for unpaid work.
That really clarifies the secured debt landscape. So let's contrast that with the complete other side of the coin. Unsecured debt, what our sources call signature debt.
Right. Unsecured loans are loans that are not backed by any specific asset. The lender is, they're essentially betting on your signature, on your promise to repay. That lack of collateral creates immediate, dramatic consequences.
Which means higher risk for them and higher rates for you. If I'm a bank, I'm suddenly looking at a potential 100% loss.
Near guaranteed higher interest rates. Since the lender has no specific asset to seize, they could lose the entire amount if you default. So the interest rate has to be higher to price in that much bigger risk. It's why a credit card always has a much higher APR than a mortgage.
But if the risk is so high, why do banks even offer things like credit cards? Does the reward really justify that potential loss across their whole portfolio?
It does, but it's a numbers game. It's all about the portfolio. The banks are relying on the majority of customers who do pay on time or who carry balances and rack up interest to cover the losses from the minority who default. That high interest rate is what makes the whole system profitable in bulk.
And when an unsecured borrower defaults, it sounds like a much messier, much more expensive process for the lender.
Oh, it is. They can't just send a tow truck. Their options are severely limited, and they're purely legal. They have to sue you first. Then they have to get a money judgment for breach of contract. And then they have to try and execute that judgment against your unencumbered assets.
Meaning assets that aren't already pledged to someone else.
Exactly. So cash in a bank account, maybe a second property,
Yeah.
or garnishing your wages, all of which is very costly and very time-consuming for them.
And in the really crucial context of bankruptcy, that priority structure becomes life or death for the lender.
Absolutely. Secured lenders have a specific claim on a specific asset, so they get first dibs on the money from selling that asset.
They're first in line.
First in line. Unsecured creditors, on the other hand, they just have a general claim on whatever is left over in the bankruptcy estate. So as a result, they usually get back a much smaller proportion of what they're owed, often just pennies on the dollar.
So what are the common examples of unsecured debt we all use?
The biggest one is credit cards. That's the classic revolving unsecured debt. Then you have personal loans for things like a wedding or consolidating debt, bank overdrafts, even those consumer loans you get at a store to buy a new fridge that's point-of-sale financing, and it's usually unsecured.
And often student loans, too.
Often, yes, though there can be some nuances there if a cosigner pledges an asset.
So beyond those two main types, our sources briefly mentioned a few other kinds of structured loans, often for very specific situations.
Right, it's worth acknowledging the variety. You have the demand loan, which is fascinating. It doesn't have a fixed repayment schedule. It has a floating interest rate. And most critically, the bank can call the loan demand full repayment at any time.
Wow, that sounds incredibly flexible for the lender, but just terrifying for the borrower.
It is. It's usually for short-term business needs. Then you have subsidized loans, which we see a lot with student loans in the U.S. Here, a third party, usually the government, pays a portion of the interest, or all of it, while the student is still in school.
And what about soft loans? That sounds generous.
It is. That's another term for a concessional loan. These are loans with terms way better than what you'd find on the open market. So super low interest rates, long grace periods. They're typically offered by foreign governments to developing countries or sometimes as a major employee benefit.
And finally, there's the one designed to bridge a financial gap quickly.
The bridge loan. A short-term, often collateralized loan used to, well, bridge the gap between two transactions, like you need the money to buy your new house before your old one sells. They're fast, but they carry much higher interest rates because of that speed and short-term risk.
Here's where it gets really interesting. So we've set up the secure-unsecured split. But the single most common delivery mechanism for both types of debt today is the installment loan. What exactly defines that structure?
The core definition is it's a contract that's repaid over time with a set number of scheduled payments. It has to have at least two payments, and the term can be anything from a few months to, like we said, 30 years for a mortgage.
So a mortgage is a secured loan, but it's also an installment loan because of its structure. An auto loan is both. It's the repayment mechanism.
That's the key. And traditional installment loans are generally seen as a safe, affordable, mainstream option compared to open-ended credit, like credit cards, or high-risk stuff like payday loans.
This stability is why regulators tend to like them.
Precisely. You can see this in U.S. federal law. The Department of Defense, for example, they actually exempted installment loans from legislation that was designed to stop predatory lending to military members. They recognized it as a beneficial form of credit that people needed access to.
Okay, let's get into the mechanics a bit. People hear fixed monthly payment, and they're talking about a fully amortizing structure. Can you explain what that really means in practice beyond the formula?
Of course, amortization means the payment amount is the same every single month. But the key thing for you as the borrower is how the components of that payment change over time.
That's the whole front-loaded interest thing, right?
Exactly. In the early years of a 30-year mortgage, the vast majority of your fixed monthly payment is just going to pay the interest. A tiny, tiny slice is actually paying down the principal.
So your debt isn't going down very fast at the beginning?
Not at all. But as you slowly chip away at the principal, the interest portion of your payment gets smaller and smaller, and more of your fixed payment starts going towards the principal. It's a slow pivot over many years.
So the borrower gets stability from that fixed payment, but the early payments are functionally weighted towards the lender's profit.
That's a good way to put it. But that consistency is what provides immense stability for household budgeting, which is why the structure has been around for, well, millennia.
Speaking of millennia, let's do the deep dive on the history here. Lending is ancient, we know that. But when did the idea of installments pop up?
The roots are incredibly deep. We have evidence of rudimentary credit systems from Mesopotamia as far back as the 10th century BC. These primitive loan contracts already had the concept of charging interest.
But the installment feature, the scheduled regular repayment, that's the key innovation we're looking for.
It is. And we can see interest being paid in installments as early as the 6th century BC.
Yeah.
Our sources found this fascinating contract from around 550 BC. It was for a simple money loan, no security, and the creditor got 20% interest.
Wow.
And that interest was explicitly made payable in installments at monthly intervals.
That's just staggering. The idea of breaking down a big debt into manageable chunks, the very basis of our modern financial lives, is over 2,500 years old.
It's clearly a time-tested mechanism. Now, fast-forwarding to the U.S., the installment idea didn't start with cash loans. It started with buying things.
Yeah.
Durable goods.
Right, the origin of the installment plan.
Exactly. It was introduced to the U.S. in 1807 by a furniture store in New York City, Cowperthwaite & Sons. They let people buy furniture and pay for it in installments, which is a huge deal for people who didn't have a lump sum of cash.
And what was the catalyst that took this from a niche retail strategy to a pillar of the American economy?
It was technology, household technology. The Singer Company was a massive driver. In 1850, they started financing their sewing machines with installment plans. All of a sudden, this expensive, incredibly useful piece of tech was accessible to working-class families.
That's the moment the installment plan starts democratizing durable goods.
It absolutely is. By 1890, the practice was everywhere. You could finance sewing machines, radios, refrigerators, washing machines, vacuums, even jewelry and clothing. It's how mass consumption finally caught up with mass production.
But the real game changer was the automobile industry. That's where this structure became truly foundational.
That's where the numbers become defining. By 1924, a staggering 75% of all cars were bought with installment loans. Without that structure, the American middle class just wouldn't have been able to afford the engine of the 20th century. It cemented the installment loan as the standard way to own major things.
Before we move on, we should briefly touch on a niche market our sources mentioned, tribal installment loans.
Yes, these are installment loans offered by tribal lending entities. The key difference, and this becomes really important later when we talk about regulation, is that they are generally regulated by independent tribal authorities. They claim sovereign immunity, they function just like a normal IL, but their legal oversight is unique. So we've established the standard installment loan is often seen as this, beneficial engine for the economy, but now we have to pivot and look at the dark side.
Where the structures of debt are exploited? This leads us straight to predatory practices.
Right. It's the difference between credit that helps you build wealth and credit that's designed to extract it.
And one form of abuse is defined as predatory lending.
This is where a loan is granted in a way that's intentionally designed to put the borrower in a bad spot, where the lender gains an unfair advantage. The subprime mortgage crisis is a huge historical example, and today the conversation is all about payday lending.
And then there's the much older, simpler concept of just charging way too much interest.
That's usury, charging an interest rate that's unreasonably and often illegally high. Consumer groups have accused credit card companies of this for years, especially with, frivolous fees designed to trigger penalty rates. Of course, the abuse can run the other way, too. A customer can defraud a lender by borrowing with no intention of paying it back.
Okay, let's define the highest risk, most debated, and most structurally unique form of debt we have, the payday loan.
A payday loan, also called a salary loan or cash advance, is a short-term, unsecured loan, and it's defined by a tremendous interest rate. It's explicitly designed to be paid back very quickly.
On your next payday, so 2 to 4 weeks later.
Exactly. It sounds like it's built for immediate, one-time cash emergencies.
That's how it's advertised, but as we'll see, that's not how it's used. The traditional way it worked was you'd go into a store and write a post-dated check to the lender for the loan amount plus their fees. You'd get the cash, and they'd hold your check until your payday.
And how has that changed in the digital age? It seems like it's all online now.
The storefront model is still around, but the online model has exploded since the 90s. Now, it's often faster and all virtual. You apply online, they deposit the funds directly into your account.
And then they withdraw the repayment electronically on your next payday.
Exactly, using the ACH network.
Okay, let's hit the core criticism head on. The price. We've all seen the staggering numbers that lead to this term, debt trap.
Because the risk is high and the term is so short, a loan might only last 14 days. The annual percentage rates, the APR, can be astronomical. Some places cap the APR, but payday loans often charge the absolute maximum the law allows.
Which can be what?
It can easily reach 400% APR, sometimes more.
Critics argue this is a market failure, that there's no real competition on price.
Yeah, the argument is that lenders have no incentive to lower their prices, so they all just charge the max. It's like implicit collusion. If you're desperate for cash right now, a 300% APR loan doesn't look much different from a 400% one. Your demand is inelastic.
But the industry pushes back on this hard. They say conventional interest rates just wouldn't work for their business model.
This is a critical point in the whole debate. They argue the fixed costs of just processing a loan, verifying your income, staffing the office, regulatory compliance are too high to be covered by normal interest. Our sources had a powerful example.
Go on.
A $100 one-week loan at what sounds like a high rate, say 20% APR, yields only about 38 cents in interest.
38 cents.
38 cents. That doesn't even begin to cover the cost of opening the file, let alone the risk of default. That really puts their cost defense into perspective. They're not built to survive on conventional rates.
They can't. They need those large front-loaded fees just to cover their operating costs, and they need the rollover fees to actually make a profit.
Which brings us to the most profound criticism, the user demographic and this whole debt trap cycle. Who is actually using these loans, and what for?
The data just completely contradicts the advertising about one-time emergencies. Most borrowers, about 69%, use payday loans to cover ordinary recurring living expenses.
Like utilities, groceries.
Utilities, groceries, rent. And this structural mismatch, using a high-cost, short-term product for long-term cash flow problem, that's the root of the trap.
And what about the demographic profile of the users?
Demographically, the likelihood of using a payday loan is demonstrably higher for renters, for African Americans, Hispanic individuals, people without a 4-year college degree, and those earning under $40,000 a year. Data from Illinois showed the majority of their borrowers earned $30,000 or less per year.
So when you use high-cost, short-term debt for recurring expenses, the result has to be persistent indebtedness.
It's almost inevitable. The average borrower ends up indebted for about 5 months of the year, not just 2 weeks. And this has a profound financial impact. Studies have found that payday loans can double the rate of personal bankruptcy by just wrecking a household's cash flow.
And a UK study found something similar.
It did. It found these loans cause persistent increases in things like bank overdrafts and other defaults.
It sounds like a structural siphon, just systematically pulling wealth out of the most vulnerable communities.
That's the consensus among the critics. These families are disproportionately unbanked or underbanked, so they can't get cheaper credit. And because these loans charge such extreme rates, they just deplete the assets of low-income communities. One group in 2013 estimated that payday lending costs U.S. communities $774 million a year in lost spending power.
And the collection and advertising tactics have also been heavily scrutinized.
Oh, yes. Some lenders have been criticized for incredibly aggressive collection tactics, like threatening criminal prosecution for check fraud, which is often illegal.
But in some places, they've found loopholes.
In states like Texas, yes, they use checks dated for the day the loan is given. If the borrower defaults, the lender can then sue them under state laws for writing a hot check, effectively using the legal system to coerce repayment. It's a chilling exploitation of the structure.
And even the big tech platforms have pushed back on the advertising side.
They have. In 2016, Google banned all ads for payday loans from its systems. They define that as loans needing repayment within 60 days or having an APR of 36% or more in the U.S.
And internationally.
The UK's Financial Conduct Authority has repeatedly had to warn consumers about these unauthorized clone firms that pop up, using the names and logos of real companies to offer fraudulent services.
So what does this all mean? We've covered the structures and the criticisms. Let's try to connect this to the bigger picture by looking at the defense from the industry and the very contradictory findings on household welfare.
Right. If the industry knows these loans are so heavily criticized, what's their core defense for charging these rates?
It really centers on two things: cost and necessity. On the cost side, they challenge the idea that they're making excessive profits. One analysis of publicly traded payday lenders found their average profit margin was only about 3.57%.
Which is actually less than a traditional bank or even a retailer like Starbucks.
Exactly. Starbucks had margins over 9% in the same period. So they argue the high fees are just necessary to cover the unusually high operating costs of this type of lending.
And that's a position that's been backed up to some extent.
It has. The FDIC's own research center found that the operating costs, fixed overhead, compliance for all these tiny transactions weren't that out of line with the fees collected, especially when you factor in the very high rate of expected defaults.
But there's a really sophisticated counterargument about how those default rates are measured, isn't there?
This is a crucial distinction. Some researchers argue that calling the default rate high is misleading because up to 80% of loans are repeatedly rolled over into new loans.
So the original principal never gets paid down.
Never. So while a loan might cycle through several expensive extensions, the actual charge-offs, the money the lender ultimately writes off as lost, are argued to be no more frequent than with traditional credit because the lender expects that rollover fee income to sustain them.
The rollovers are the lifeblood of the business model. It's built on persistent debt.
Precisely. The second major defense is the necessity argument. Proponents argue they provide vital credit to high-risk, poor households who have already exhausted every other option and would otherwise have no access to credit at all,
potentially forcing them toward illegal loan sharks. That's a powerful moral argument that high-cost credit is better than no credit.
But is it actually supported by the evidence? Does capping these rates push people toward illegal sources?
It's heavily disputed. Research suggests there's actually little basis in fact for that. When states implement rate caps, borrowers tend to turn to family, friends, or other methods. They don't seem to be turning to criminals in large numbers.
Okay, let's talk about the complex studies on household welfare because the findings seem to just completely contradict each other.
They really do. Donald Morgan at the Federal Reserve Bank of New York argued that you can't automatically call payday loans predatory, which he defined as welfare-reducing credit, because they might actually relax a consumer's credit constraints and improve their welfare in some way.
Meaning that cracking down too hard could actually harm consumers by taking away a needed option.
That's the implication. But then, other researchers found the exact opposite. Brian Meltzer at the Kellogg School found that payday loan users did suffer a measurable reduction in financial stability. because the constant high cost of rollover loans crowded out their ability to pay for essentials like rent and utilities.
And the Federal Reserve Board itself found some ambiguity on the bankruptcy question.
They did. A 2014 study found that while bankruptcies did double among users, the overall number was too small to be statistically significant. And they found no real impact, positive or negative, on people's credit scores over time. It just highlights how hard it is to define what's truly predatory.
There was one study, though, that found a surprising positive effect in a very specific high-stress situation.
Yes, in natural disaster areas. A 2011 study found that in disaster zones where payday loans were available, consumers actually fared better financially. They had fewer foreclosures. It seems the immediate access to cash, even at a high price, helped them manage those unexpected costs.
This complexity means there are also external costs that we rarely talk about.
Exactly. When a borrower is trapped, it impacts everyone. They're less likely to pay off their other cheaper debts. They're less likely to shop at local businesses. These are costs borne by the whole community.
Okay, let's shift gears completely for a moment and look at the U.S. tax handling of all this. How does the Internal Revenue Code treat loans?
It's all governed by a principle called accession to wealth. Since you, the borrower, have an obligation to repay the loan principal, that principal is not considered gross income to you.
It's debt, not profit.
Exactly. It's not income. And for the lender, the principal they get back isn't income either. So the principal amount moves back and forth, tax-free.
So where does the tax come in?
The interest. The interest paid is compensation for the use of the money. That's profit for the lender, so it's always included in their gross income. For you, the borrower, the interest you pay might be deductible, usually if it's tied to a business. The big exception most people know is home mortgage interest.
Now, here's the detail that I think surprises a lot of people. What happens if the loan is never paid back and the debt is formally canceled or discharged?
This is where that accession to wealth principle flips the script. Even though a loan doesn't start as income, if a debt is discharged, canceled, or forgiven, that discharged amount becomes taxable income to the borrower.
So if a bank forgives $10,000 of your debt, you have to report $10,000 as income on your taxes that year.
That's precisely right, equal to the amount that was discharged. The IRS treats it the same as if the lender had just handed you a check for that amount. There are some exceptions, like if you're insolvent at the time, but the general rule is clear. When the obligation to repay is gone, the debt becomes income.
When we look at the regulation of payday lending, the U.S. picture is it's incredibly fragmented, right? A total patchwork.
That's a perfect description. As of 2014, payday loans were fully legal in 27 states. 9 others allowed some restricted form of it. But the other 14 states and D.C. essentially forbid the practice through very strict interest rate caps.
But the federal government did step in to create some overarching oversight, especially after 2008.
The Dodd-Frank Act was the key there. It gave the Consumer Financial Protection Bureau, the CFPB, specific authority to supervise all payday lenders, no matter their size. And the CFPB has brought a lot of enforcement action since then.
And there's one group of people that is explicitly shielded by federal law.
The U.S. military. The Military Lending Act is a very powerful piece of legislation. It imposes a hard 36% rate cap on most payday and auto title loans made to active duty military members and their families.
Why that specific protection?
Because military personnel were historically targeted by these lenders, and having service members in financial distress is considered a national security risk.
Now, in the states that have outlawed these loans, how do lenders get around the rules?
They often exploit loopholes related to jurisdiction and sovereignty. The most common way is by partnering with Native American reservations, offering loans online that claim tribal sovereign immunity to get around state law.
These are the infamous rent-a-tribe schemes.
Exactly. While some tribal lenders are genuinely operated by Native Americans, there's a lot of evidence that many are just financial shells for non-native companies trying to use immunity as a shield. The FTC is now monitoring these arrangements much more aggressively.
Okay, let's look internationally for a second, because the UK completely overhauled its payday lending market with a fundamentally different approach than the US.
The UK approach is defined by concrete caps. The Financial Conduct Authority, the FCA, took over in 2014 with a mission to make sure firms only lend to people who can actually afford to pay it back.
And they implemented 3 very specific hard cost caps that changed the whole business model overnight.
The rules are incredibly clear. First, an initial cost cap of 0.8% per day on the amount borrowed. Second, fixed default fees are capped at just £15. And third, the biggest one, the one that directly addressed the debt trap, a total cost cap of 100%.
That 100% total cost cap is huge. It means if you borrow £100, the absolute maximum you can ever pay back, including all fees, interest, everything, is £200.
That's the rule. You will never pay back more than double what you borrowed. And that move just fundamentally decimated the rollover model that U.S. lenders rely on for their profit. It forced UK lenders to underwrite much more carefully because their total profit on any single loan was strictly limited.
We also saw new UK regulations for secured loans.
Yes, the Mortgage Credit Directive in 2016 harmonized the rules for first mortgages and second mortgages, like home equity loans, putting them all under the same strict consumer protection framework.
And looking at other global examples, the approach to unsecured debt often changes based on how you can manage the risk.
Look at Malaysia. Personal loan rates for private sector workers are way higher than for government workers. And the reason is a centralized payroll system called Bureau Angkasa. The bank can arrange to have the loan payment deducted from a civil servant's salary before they even get their paycheck.
So they've essentially secured an unsecured loan by guaranteeing the repayment?
Exactly. It makes the risk so low that the interest rates just plummet.
And Singapore took a different approach, focusing on preventing people from getting too much unsecured debt in the first place.
The Monetary Authority of Singapore, MAS, put in strict rules. They cap any additional unsecured credit for borrowers who already owe more than 6 times their monthly income. And there's a total limit of 12 times your monthly income. It's a proactive measure designed to maintain household stability.
Finally, for a borrower who's stuck in that high-cost debt cycle, what are the actual low-cost alternatives, the ones they often turn to after they've already defaulted on a payday loan?
The sources list several. Pawnbrokers, which is one of the oldest forms of secured credit. Credit union loans, which almost always have better rates and more flexible terms than commercial banks.
And we're seeing some employer-driven models pop up too.
Yes. Earned wage access systems, like FlexWage, where you can access a portion of your salary that you've already earned. It solves the immediate cash gap without the high interest.
You could also turn to a vehicle-secured loan.
Right, an auto title loan.
Yeah.
It's still risky, but the terms are usually slightly better than an unsecured payday loan because the lender can repossess the car, which lowers their risk.
And there was one really interesting historical suggestion for a truly low-cost, widely accessible alternative.
The idea of reviving the United States postal savings system. The USPS Inspector General suggested in 2014 that the post office, which has a branch in every community, could offer basic banking services, including small dollar loans for under 30% APR.
That would be a true market disruptor.
It would. It could provide genuine competition and potentially force the high-cost lenders out of business in some areas.
So we started this deep dive acknowledging that a loan is just a reallocation of assets over time. We've gone from ancient Mesopotamian contracts all the way to a modern financial world that's defined by this crucial split between secured assets and unsecured risk. The structure of the loan is everything.
It really is. And if we connect this to the bigger picture, the core tension is still there. How do you provide necessary capital to high-risk people shut out of traditional banking, without creating these predatory structures? High-cost loans persist because they service a population that traditional lenders simply won't touch. It's a really complex social and economic problem.
And it's a knowledge problem, too. The real trap happens when a borrower uses a short-term, high-cost loan for a long-term recurring expense. Just understanding that the structure is mismatched to your need is the first and best defense.
It absolutely is. So, as a final provocative thought for you to consider, look again at the UK structural solution. They imposed a 100% total cost cap. A borrower can never pay back more than double what they borrowed. Now, that rule fundamentally breaks the U.S. business model, which relies so heavily on repeated rollovers to make its profit. So the question is, given the clear, measurable impact of that cap, why hasn't that straightforward regulatory model gained wider traction here in the U.S.? And what does its absence imply about the influence of financial interests versus consumer protection in shaping our own debt landscape?